Something strange happened this week on Wall Street. Three companies reported strong earnings. Not decent earnings, not in-line earnings. Genuinely strong, beat the estimates, raised guidance earnings, and their stocks got crushed anyway. Broadcom down over 12% on earnings day. Planet Labs down 22% in a single session. Palo Alto Networks pulling back after a run that had taken it up 70% in 3 months. If you watched that happen and thought something seems broken here, you were paying attention. Because something is happening beneath the surface of this sell-off that most retail investors will completely miss. And by the time they figure it out, the opportunity will already be gone. Let's start with the obvious question. Why is tech selling off when the news is actually good? The easy answer is sector rotation. Some of these names got frothy. Investors are trimming positions, locking in gains, moving money around. That happens. It's normal. Markets breathe. But there's a second explanation that almost nobody's talking about in plain terms. Next week, SpaceX is going public. Not a small company, not a niche play. SpaceX, the most anticipated IPO in a generation. And institutional investors, the ones who move markets, need liquidity to position for it. So what do? They sell what they can sell, fast, in size. And the stocks that are the most liquid, the ones with the highest trading volumes, the ones that have run the hardest in the past month, those are the first to go. Palantir down, chip names selling off, cybersecurity pulling back. It's not a verdict on these companies, it's a cash register opening. And that's actually the most important thing to understand before we talk about any individual stock. The market this week isn't telling you these businesses got worse. It's telling you that someone bigger than you needed to raise cash in a hurry. Which means, if you read it right, it might be telling you something else entirely. It might be telling you to go shopping. The first name worth looking at closely is Broadcom, ticker AVGO. And the setup here is genuinely counterintuitive. The company just reported record revenue of $22.2 billion. Record. Not a small beat, not rounding up to look impressive. An actual record quarter. And the stock dropped 12% the day earnings came out. It's still sitting roughly 10% below where it was before the report. Here's why that happened. And it has nothing to do with Broadcom specifically. When a stock runs 53% in 12 months and then prints a quarter that's strong but not supernatural, the market does something irrational that somehow keeps happening anyway. It punishes the company for being good but not transcendent. Investors had priced in something extraordinary. They got something excellent. And apparently, in the current environment, excellent isn't enough to hold a stock at its highs. The guidance wasn't raised. It was reiterated. Same target, same trajectory. No surprises down, but no fireworks up either. And so the stock got sold. Now look at where it landed. Broadcom pulled back almost exactly to its 50-day moving average. That's not a random number. That's the line that technically oriented investors watch to decide whether a trend is still intact. And right now, that moving average is still rising. The momentum hasn't broken. The floor just got tested. If the stock holds here, this starts to look like a textbook dip inside an uptrend. If it breaks below this level, the next meaningful support is somewhere around 360, and below that, closer to 300. The longer-term case doesn't really care about any of this short-term noise. Broadcom is a chip company operating in a moment when chip demand has structurally changed. Not cyclically, structurally. The hyperscalers, Amazon, Google, Microsoft, are spending billions building out AI infrastructure, and they've told investors clearly that this spending isn't slowing down. Broadcom sits inside that supply chain in a way that's difficult to replace, and unlike some of the more hyped names in the space, its valuation, even after the run-up, is relatively reasonable compared to its peers. This is not a stock you chase, but it might be a stock you accumulate quietly while the market is distracted by something shinier. The second name is Palo Alto Networks, and this one requires a different kind of patience. Cybersecurity has had a strange few years. There was a period not long ago when software stocks broadly got hammered on fears that AI would essentially make traditional security platforms obsolete. The SaaS apocalypse, some called it. The theory was that companies would consolidate vendors, cut spending, and a lot of the legacy players would shrink into irrelevance. Palo Alto's CEO addressed the theory on the earnings call this week, with the kind of bluntness that you don't often hear from corporate executives. He called the narrative cyber dead, and the numbers are starting to back him up. Next Generation Security, ARR, annual recurring revenue from the company's newest platform, grew 60% in the latest quarter. Net retention rate sits at 120%. That's the metric that tells you whether existing customers are spending more over time or drifting away. 120 means they're not just staying. They're deepening their relationship with the platform. The company raised its guidance. Free cash flow is strong. But here's the uncomfortable truth about this one. The stock just hit an all-time high last week, right before earnings. And even with the pullback this week, it's still trading well above its 50-day moving average. It's up 70% in 3 months. This is not a stock that has quietly corrected to a comfortable entry point. It's a stock that sprinted up a steep hill and is now catching its breath on a ledge. The logic of the SpaceX dynamic applies here too. Institutional repositioning, summer seasonality, lower volume months ahead. There's a reasonable case that this one drifts lower before it finds its next leg up. The numbers to watch are around 260 to 250. Below that, 240 and even 215 become realistic. None of that changes the long-term thesis. In a world of agentic AI, systems that don't just answer questions, but take actions, make decisions, interact with other systems autonomously, the attack surface for cybersecurity threats doesn't shrink. It explodes. Every new AI agent is a new potential vulnerability. Every automated workflow is a new entry point. The companies that can manage that complexity at scale are not going to get smaller. They're going to become infrastructure. Palo Alto wants to be that infrastructure. The earnings suggest they're building toward it. The question is simply whether you want to chase it here or let it come to you. The third name is the most interesting one, and also the most chaotic right now. Planet Labs. Ticker PL. And the story this week borders on absurd. The company reported earnings last night. Revenue up 42% year over year. Loss in line with expectations. Subscription model intact, government contracts renewed. Nothing in the report was wrong. And the stock is down 22% today. To understand why, you have to understand what Planet Labs actually does and why the market has suddenly decided to panic about it at the exact moment SpaceX is about to go public. Planet Labs operates a constellation of satellites designed to photograph every point on Earth every single day. Every day, not every week. Not on request. Every day, continuous, persistent imaging of the entire planet. They sell that data to defense contractors, governments, commercial companies, anyone who needs to know what's happening on the ground, at scale, in real time. The customers aren't one-time buyers, they're subscribers. That's important because it creates revenue durability. You don't have to resell them every quarter. They pay, they renew, they often expand. It's the kind of business model that investors love when they slow down long enough to think about it. But right now, nobody is slowing down. Right now, the market is in full SpaceX mania mode, and any stock in the space sector that isn't literally SpaceX is getting caught in a weird gravitational pull where the IPO hype simultaneously inflates the sector and creates selling pressure within it. The stock ran over 900% in the past year. 900. And so a 22% correction, while jarring, is actually relatively modest given the altitude from which it started. Analysts at Wedbush and others came out this morning with price targets at or above $50. The stock was at $50 before it started selling off into earnings. Those analysts are essentially saying the price target is still valid. It just got there too fast. That's not nothing. That's actually a signal worth paying attention to. Planet Labs isn't SpaceX. It's not building rockets. It's not going to the moon. What it is doing is something quieter and potentially more durable, building the data layer on top of the space economy. Someone has to sell the picks and shovels while everyone else is rushing to mine. Planet Labs is making a case that it wants to be that company. Here's the broader thing to sit with after all of this. The market right now is behaving like a crowd at an auction that just spotted the painting they all want. Everything else in the room gets ignored. Prices drop on things that probably shouldn't be dropping. Attention collapses into a single point of focus, and then the auction ends, and people look around and notice what they overlooked. SpaceX hasn't even gone public yet, and it's already reshaping the behavior of institutional investors, distorting short-term prices, and creating noise that looks like signal to everyone watching their portfolio turn red this week. The question isn't whether any of these three companies is worth owning. The fundamentals suggest they probably are at the right price with the right time horizon. The question is whether you're reading the tape correctly, whether you can tell the difference between a company that got cheaper because something broke and a company that got cheaper because everyone temporarily stopped paying attention. One of those is a warning. The other is an invitation. Most people can't tell the difference in the moment. That's why the opportunity exists at all.